Hello and welcome to ERM Advantage and part 2 of our series on the enterprise and operational risk assessments. In part 1 of the series, we talked about the foundational principles of risk assessments. If you missed that, you can go back and catch that video here. So now that we've covered all of that, we're going to get into the specifics of assessing enterprise and operational risk. Starting with operational risks, since that's a little more familiar territory, then we'll move on to the macro areas of strategy and external risks. So before diving into effective methods for developing operational risk assessments, let's consider some of the problems and challenges that I consistently see in organizations that often lead to less than desired results. Number 1, more of a documentation than discovery exercise. Going back to an earlier video, the focus is more vanity, documenting controls in place, rather than sincerely asking the question, do we truly understand our risks and our risk treatments? Number 2, unclear scope and purpose. I know this seems ridiculous, but do we really know what we're looking for? Number 3, unclear roles and responsibilities. The wrong people participating in risk assessment process, both within the business units and across first, second, and third lines. Ambiguity on who owns the risk assessment, etc. Number 4, structured in all risk terminology, not in the language of the business. We've talked about that several times. Number 5, narrow focus primarily on internal controls, ignoring important mitigants that aren't internal controls but are just as meaningful. Number 6, risk registers that include non-key risks, registers containing minor or moderate risks, which only frustrates the business unit and tends to diminish their perception of the value of the exercise or the results. Number 7, confusing risk versus risk sources. Risk registers polluted with risk sources which are impossible to quantify. Number 8, subjective risk ratings. Subjective guesstimates of risk ratings, certainly better than nothing, but frankly not very useful. Number 9, risk ratings with no narrative support, providing no rationalization for ratings, giving nothing to challenge. Number 10, unsound calculation methodologies. And I talked about this briefly before in another video, but we're going to go deeper in this series. Number 11, no definition of acceptable risk levels. The goal was an arbitrary estimate of residual risk, but falling short of empowering the business to make statements about when mitigation levels are sufficient. And number 12, no takeaways or action items. Again, only seeking to document what is known and either ignoring or avoiding any consideration around what improvements could or should be made. Now again, not to worry, we're going to cover all of these in this series. Now, as I said, assessing operational risks is often fairly familiar territory for many risk managers because, frankly, so many enterprise risk assessments and, regrettably, a lot of GRC solutions are really designed around these kinds of risks, and unfortunately, often at the exclusion of the more macro risks. Nevertheless, despite this familiarity, there are still some aspects of operational assessments that are still conducted wrong or at least inefficiently or unproductively. So we're going to go step by step in developing effective operational risk assessments and then also discussing a range of tips and tricks that have really proven to be highly beneficial when adopted. So we're building out our assessments. We're going to build on the 2 key questions we introduced in the first video. And for each type of assessment, we're going to ask or establish what is the scope of this exercise? What is the foundation we're going to be focusing on? What are the specific risk factors or focuses we're going to be looking at? And what is it we're trying to determine? For each of these, we're going to consider, for context, what is it we know? What is it we partially know or we believe? And what is it we really only can estimate? Then we'll walk through the entire process, start to finish. Okay, so let's provide some definition to our assessment. What is our scope? Well, it's all business units and the processes in place to basically support day-to-day operations in pursuit of achieving the strategic objectives. What's our foundation? Well, it is those operational processes and the business unit's understanding of the expected outcomes in those processes. What is our risk focus? It's plausible alternative outcomes and external events, not influences, but events. The treatments in place to address potential risks, and ultimately the residual risk profiles. What are we trying to determine? Well, we're trying to figure out the potential impact of those possible outcomes and whether residual risk levels are considered acceptable. So, for every assessment, we can define a knowledge stack, again, distinguishing between what we know, what we think we know, and what we can estimate. So for this assessment, what do we know? Well, we know the processes, we know the process owners, we know our risk mitigants as they exist today, and we know what is our expected outcomes. So our goal here is really just challenge and verify that knowledge or understanding. What is it we think we know? Well, we think we know possible outcomes, or all possible outcomes. We think we know the impacts of some of those plausible alternative outcomes. We think we know the mitigants that we have in place for some of those alternate outcomes. We think we know what our residual risk looks like, and the related underlying assumptions related to those. So for this step, really what's our goal? Our goal is to challenge, improve wherever possible, and expand our knowledge, build on as much as possible our understanding of these different elements. And finally, what is it we've estimated? Well, mainly it's the residual risk level and really the potential impacts, the full understanding of that. So here our goal is, continued discovery, continued challenge, evaluation, and fine-tuning those elements that we are estimating to get the most useful information possible. Okay, so now we begin a process of preparing to roll out this operational assessment. Now we've established our scope, which again is enterprise-wide. Did I just say enterprise-wise? Enterprise-wise. Yes. Yes, I did. Enterprise-wise by business unit. Now, we're focusing on the first line, which includes all of our revenue-generating areas, lenders, branches, etc., the operational areas that are there to support them, loan operations, deposit operations, IT, etc., and the various administrative support functions, finance, HR, etc. Now, I will occasionally see certain second-line processes included in an operational risk assessment. While not necessarily wrong, I don't believe this is appropriate or even makes sense. We generally exclude second and third lines because those processes are not operational. They're part of an overall governance function. These should be evaluated as part of the macro level where we're asking the question, are these policies, programs, and teams sufficient to effectively manage risk in the second and third line? Now, we'll obviously cover that in a lot more detail in the next section where we talk about more macro level risks, which includes our governance areas. This also reinforces, as a sidebar, why it's a good idea not to have audit and risk aligned in the same organizational unit. There's a benefit to having them in separate organizational lines because, frankly, I want risk to be keeping an eye on internal audit. I want internal audit to be able to audit risk, and you don't gain anything by joining them. But for the purposes of our operational assessment, we really are focusing on the first line and all their related processes. Now, as we think about our business units, we also need to be smart. Areas that have homogeneous processes, like branches, for instance, we're not going to look at every single one. We could do a representative sample that represents the processes within those areas. In truth, areas like that, particularly branches, really don't have a lot of key risks. They tend to have more of the more moderate and lower risks. If we have several business units originating, say, the same type of loan product, we could combine those. In many cases, the loan origination is loan origination. They're basically similar processes and, frankly, similar risks. So again, we want to be respectful of people's time, and if we can combine areas, we should do that. We're really trying to focus on areas that have unique processes, unique controls, unique risks, etc. Now, alternatively, Some areas can be very complex and multifaceted. IT, for instance, you're not going to take that all in one pass because there are very different functional areas that have different teams, different processes, etc., in which case we'd want to break those up into multiple groups and workshops. So let's take a look at a sample inventory of what a group of business units might look like. And every organization is going to be different, but this just kind of gives us a working example to look at in a possible level of granularity. Okay, so let's start to think about how we might structure an inventory of business units in which to organize and structure our operational risk assessment. This would be based on a fairly typical financial institution. Obviously, everyone is going to be unique to that environment. There's going to be probably a branch administration area, and again, your branches are all going to mostly set up the same because they're going to have similar processes and hence similar risks. So you would do a representative sample for each of your branch areas. Then we would have lending areas, might be a commercial area, a consumer area, maybe a mortgage area, and then the related supporting areas, the loan operations area, deposit ops, maybe a call center, maybe a facilities team. And then technology typically would break down between an architecture group, a network operations area, maybe an application development area, a help desk, and maybe some other area. And then finally, administration, which is going to be your finance area, treasury, human resources, marketing, etc. Now, in your environment, facilities might be part of administration, or consumer lending might be done only out of the branches, and that's fine. So we can just pick those up as part of that group. Or you might have your IT area part of operations. That's all fine. Or you might even have a private banking team that does both lending and deposits and services. Again, what's most important is that we've at least identified what are the unique groups that support these various functions within the bank to sort of come up with our inventory of business units. So whatever we come up with, again, we could always subdivide later, but the general rule is we think about where are there groups of people that are operationally fulfilling certain functions. And then this becomes the basis for our inventory of the groups that we'll use as part of our operational assessment and the related workshops. So once we have our inventory of business units completed, now we want to start to think about who we want to participate in this risk assessment process. For initial workshops, there's really no right and wrong, but ideally we want to have people that are familiar with the processes and related controls. Typically there's at that manager supervisor level and maybe one level below. I don't want everybody in a business unit because too many cooks in the kitchen always spoils the soup. Going the other way, we also don't want your senior folks, maybe SVPs or EVPs or division heads, in the workshops for a couple of reasons. Number one, this probably is not efficient or effective use of their time. Number two, more often than not, they're too far removed from day-to-day processes and risks and controls, and one of several things will happen. As processes are discussed and risks are discussed and they start learning how the sausage gets made, they may take you down rabbit holes to understand these, ask questions, and try to fix things on the fly. This is not efficient use of time. At minimum, their presence will probably shut down open discussion with the worker bees. Much better to have them review materials once they've already been drafted. So we want a handful of people around that sort of manager, supervisor level, enough to credibly understand the processes and the business purpose of the group. Now, it is fairly common to have someone from the second line or risk management staff or an external resource participate and facilitate these workshops, which is fine, as long as they understand that they are facilitating and providing subject matter expertise, but it is the business unit who owns the risk assessment. We'll talk about this more when we walk through the actual workshops. In addition, there's often I've heard interest in having somebody from internal audit sit in on these workshops, the idea being that they could bring some additional insights into processes and risks.
No, God! No, God, please, no! 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 No!
This is a bad idea, and frankly is not appropriate to have internal audit in those workshops. This is the business unit's time, and they need the freedom to be able to speak openly and honestly, and frankly, it's none of internal audit's business at this point. It will shut down the conversation for people fearful of talking about controls that maybe could have weaknesses for fear of internal audit picking up on that. Again, it's just not appropriate. It's much better to let the business unit work through this, develop their draft assessments, and then bring an internal audit in a follow-up workshop to review them and provide some challenge and input there. Now, one thing that is critical, there must be an understanding with internal audit of safe harbor for the business, meaning if through this assessment process a business unit has identified a weakness, they have time to address it. It cannot become an immediate finding of internal audit. This is non-negotiable, because if the business units start finding out that they divulged something and audit picked up on it and either turned it into an audit or made it a finding, you will destroy the assessment process. You're done. You have to have an understanding with internal audit that anything that's disclosed could be noted as self-disclosed, but again, the business unit has to be given a reasonable amount of time to address any of those weaknesses. Now, if they don't solve it in that time, fine, that become an audit item. But internal audit must agree that findings could be brought up by the business, self-disclosed, that do not become internal audit items. Now, a couple of points as we think about preparing for this assessment process. Now, I'm going to be describing this as if it's a first-time process, and later we'll talk about subsequent iterations where the focus is really more on what has changed. However, if in prior assessments, if you didn't capture many of the elements that are described here, it may be worth going back and actually hosting some comprehensive workshops as if it was the first time, but just start from the information you have. Second, I'll be describing this process using assessment workshops. Now, while that will work for most banks, it may not work for some of the largest banks where you have perhaps hundreds of business units. I understand that. This could be structured using templates or a software tool, combined with some training videos, but again, using some of the same concepts. However, if possible, I still suggest you consider using workshop formats, particularly in areas that maybe are struggling to understand some of the risks, simply because it yields the best results and most actionable information, even if you have to bring in outside resources to facilitate the workshops. Now, in this series, I'm going to be using a series of Word and Excel documents to walk through this process. Now, even if you're using a GRC or software solution for managing risk, it still may make sense to do these workshops using Word and Excel templates. You can see all the information in one place while you're together, and if you're using a GRC tool, you're only seeing one screen at a time and the information can get lost. So there's really nothing wrong with doing the workshops using templates and then uploading that information into your GRC tool later on. Next, if this is a first-time process, do not pre-populate templates, and I cannot say this strongly enough. Look, the reality is for risk professionals, we probably already know what are some of the key risks for certain areas. We probably already know what their processes are, but this needs to be a discovery process by each of the business areas. And I know this sounds incredibly inefficient, but if you pre-populate the information, several things are going to happen. Number one, the first line will never own the information. They will always fall back on, I don't know, that's just what the risk team put in. And two, they may just skim over it, look at it and go, yeah, that's good enough, particularly if they see it as a documentation exercise. All of that completely defeats the purpose. So again, this is a discovery exercise, not a documentation one, and therefore it needs to be discovered. Okay, next is communication. In order for this process to be successful, there has to be a lot of communication. So, starting with a discussion with the senior leadership at a management risk committee or senior leadership meeting or some other forum. In this process, it gives you an opportunity to set expectations, get buy-in, get support, address any questions or concerns that management might have before beginning the process. Reinforce the idea that this process is designed to create value, not just documenting, but discovery, and includes opportunities for thinking about process improvement as well. Most importantly, it's asking leadership for their support, sending messages among their teams to support this process and be engaged. Second, it's also a very good idea to start with a company-wide message, ideally from the CEO. Again, setting the message, setting the tone, telling people, look, we're going to be doing this process. Please participate. Be honest. Be present. This is critical to our success. If something can be improved, a process, controls, we want to know about it. And while risk may be facilitating this discussion, this is your assessment. You as the business units need to own this assessment. This can go an incredibly long way in getting buy-in and support by people understanding that it has full management support. Next, advanced communication to the business units. You cannot just schedule workshops. That is a disaster. So, to your business unit heads or executives at that sort of EVP-ish level, you may have already communicated at a risk committee, but this catches everybody. Make sure everybody's really gotten the message. Again, encourage everyone to participate. Be honest. Be transparent. We need to understand, what is going on in our environment, where there are risks, and whether we've successfully mitigated our risks. Now, again, you may need to reiterate, we prefer that the senior executives don't participate, but if they do, you need to let them know you need to speak last. Let your team speak. Let them discuss things about process and risks. Encourage input, encourage openness, and then if you want, layer in your thoughts at that point. But they can't go first, or everybody else will just defer to their opinion. Ideally, let the process happen and then let them see the results. But again, that may depend on everybody's leadership. Now, to the business units themselves and those who are going to be participating in these workshops. So you can ask them to start thinking about their environment a little bit. And this is where we want to sort of be careful. You could certainly ask them to be just thinking about how they would describe their purpose, their processes, and certainly what's changing in their environment, and we'll see why. We could ask them to start thinking about risks, but again, I want to urge caution here. At minimum, just say don't over-focus on this. What you don't want is you don't want them to go through and come up with a list of 50 risks, and then you get in the workshop and you have to walk them back because most of those aren't even relevant. You would have just wasted their time. If all they did was just think about how they articulate what is they do, what's their purpose, what are the major processes they have, and what is changing, that would give you a really good running start for the workshops. You could also ask them to start thinking about process improvements. Again, that's a very fair game for this process, and frankly, they probably already have some things in mind that they've been thinking about. Now, distributing forms in advance is unfortunately a bad idea. And again, if you limit it to just those earlier parts of your business purpose, that can work. But the problem is that by sending out forms in advance, you run the risk of saying, okay, we did it. Do we still need to meet? And again, you're really not accomplishing anything, and you're only saving minutes in the actual workshop itself. So frankly, I'm really not a fan, but if you do send out any forms in advance, again, limit it to very high level information, if only to get them thinking. It's also a good idea to have a conversation with your regulators. I mean, frankly, just make them aware that you're beginning this assessment process. They're obviously very interested in your operational processes, and just say, hey, we'd like to show you how we're going about this, and are there any particular areas you'd like us to pay attention to, maybe where you have concerns or look for? A little proactive communication actually goes a long way with them. And finally, there's some advantage to some training, and in particular because by the nature of an assessment, we may be introducing some new language, some new terms. And this could be done one of several ways. You could do it by taking a part of the first part of a workshop, maybe the first half hour, and do a little orientation around forms and terms. That works fine. Another alternative that works pretty well is to establish or schedule some training classes that like anybody can attend. You could do a series of virtual sessions where again you could do some introduction to concepts, forms, terms that people could attend in advance of the workshops to give them a little bit of a running start. Obviously that can be more efficient because then you don't have to take that time in the workshops. Both have pros and cons, and both can work effectively, but just something to consider. But you do need to consider how you're going to do some of that training around what we're doing and how we're going to do it. Next, preparation for facilitators, whether that's somebody from risk management, a PMO person, or somebody from the outside. If you're going to be facilitating workshops, you need to be prepared to be able to do that. So obviously that means reviewing certain materials in advance. For instance, any prior risk assessments, whether operational or sub-assessments, compliance, InfoSec, etc. Particularly, you want to pay attention to any prior assessments that have specific findings or follow-ups. Those obviously need to be carried forward into this conversation. Certainly, you'd want to review any previous audits, and particularly any findings from those, any related SOX documentation, and where possible, any industry information that might give some insight as to considerations for this particular area of operations. Anywhere useful information can be obtained that will help assist in the process of the business being able to identify their processes, their risks, their mitigants, etc. And obviously you have to be familiar with the templates that are going to be used. I mean, you need to be the experts. You can't be sort of figuring them out as you go once you're in the workshops. So speaking of, now is as good a time as any for me to introduce the templates that we're going to be using in this series to highlight the process. Now, I'm going to be using a series of Word and Excel templates to illustrate this, ones I've been using for many years and have really worked very successfully. But the same concepts could also be built into a GRC tool if you approach it sort of the same way. So I'm just going to kind of give a quick overview of these templates. Obviously, we'll be going through them line by line as we go through the assessment process, but just give us a basic orientation. We're basically going to be using a set of 3 templates that work together. And the first of these is just an overview document. It's a simple Word document that just allows us to capture some of those overview elements that we talked about earlier. A little bit about the business unit, a little about the environment, etc. And then ultimately concluding with our list of core processes and related key risks. This document is designed to give a basic overview of the business unit that anybody could read and get a really working understanding of how this business unit operates and what they see as kind of their key risks and some of their summary of how they mitigate risk. The next 2 are sort of sister documents, and one is a narrative. It's a risk narrative, and it allows us to provide an area where we're going to talk about descriptions of the inherent risks, descriptions around risk mitigation and related treatments, and then around residual risk. And this is where we can provide a narrative understanding of the risks in the environment, as well as some other pieces of related information that we'll talk about. And then finally, our risk rating sheet, which is, again, the sister document to the narrative, but this is where we're actually going to go in and assign risk ratings for each of these risks, so we get a full picture of the risk profile. Now, we'll also cover details around subforms and how we aggregate all this information together later on. I want to reiterate that as I announced in a prior video, that the templates that I'm showing and using, I am making those available to sort of early watchers of this program at no charge. In the future, I may make these available as part of a bundle for purchase, but for right now, to encourage review and feedback, again, these are available, so all you have to do is just email me at ermadvantage@gmail.com, and I will provide you a copy of these templates that we're using at no charge. Now, I think this gives us a really good place to take a pause, as we've covered an awful lot. In the next video, we're going to go deep into risk identification, ratings, narratives, mitigants, and aggregating this information together into truly meaningful, actionable reporting. And before we go, please don't forget to hit that like button, the subscribe button if you haven't already, and the notification bell so you'll be notified when new videos are available. Thanks for watching.